Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of the Chicago soybean complex.
Chicago soybeans. 8 weeks ago here, and at every opportunity since, I said, and I quote, "The only other thing to bear in mind is not here on this daily chart, but in Chicago soybean meal." And that is the well-highlighted annual key reversal down we saw there for 2023. Not directly related here, but not worth ignoring either. End of quote. I know I sound utterly boring, but this point is important, and I feel I must keep repeating it, such that in all things this year and going forward, all things should be seen in the shadow of this pattern. Okay, so from the May double top, prices headed lower until in mid-August they met the optimized neckline extension, currently at 924, of the February to October 2021 head and shoulders top. This stopped the market's decline dead in its tracks, and prices have reverted back up since, creating a dark blue mid-August to mid-October bull channel, currently 1053 to 1119. The market also created a slightly wider pattern, a late July to late September reverse head and shoulders pattern for bright red neckline, currently at 1029, below the market, and a potential primary target X overhead in the 1096 area, with a secondary harder to reach target X1 up in the 1123 area. The market has overcome a variety of resistances on its way up from the break higher in mid-September, but what still lies ahead overhead that may try and cap any rises? Well, immediately overhead we have the declining mauve medium moving average, currently 1075, with next the 50% Fibonacci line for May to August move at 1098. Beyond that we have the December 2020 low at 1143, as well as declining long moving average, currently at 1138, which may be a gateway to a variety of congestion areas between 1155 to 1161, then 1178 to 1181. Any further move higher would also help fill in the changeover gap from July between 1056 to 1103, which has so far been only partially filled in. To be honest, it still looks like light work topside until the December 2020 low. However, this week prices have exited down and out of the dark blue mid-August to early October bull channel, though not by far. The exit is enough to put the bull channel on notice of being downgraded, but there is an important caveat to all this. You see, the drop has only been as far as the bright red neckline of the late July to late September reverse head and shoulders bottom, currently at 1026. This makes me a little suspicious as to whether the break lower is indeed a true break. It might be false. We shall know over the next few days, but the next support is the combination of the green short medium moving average, currently at 1015, and the congestion at 1017. Beyond this is the congestion at 990. Finally, there is still a big picture idea out there of the action since the double top in May to date as a possible descending scallop pattern. For this pattern to realistically work, prices, as I said last week, and I quote, would have to soon halt and then decide whether they wish to remain bullish or bearish before making their move. It's a bit early to say if this pattern will fully deploy right now, end of quote. Now, I have nothing further to add to this part of the commentary right now at this moment. Chicago soybean meal. The main pattern driver in this market had been, and now possibly still is, the dark blue November 23 to early May 2024 bearish shift pitch walk that you can clearly see on my daily chart. This pattern had been breached and arguably broken only as recently as the last 2 weeks, with prices having consecutive closes over the dark blue upper time, currently at 324.80. However, please note, this break higher was not a spontaneous move, but rather the result of the construction of bullish incentives, notably the mid-August to date bright red bull channel, currently 329.40 to 361.5. And I'll speak more on this bull channel shortly. Then there's the change of the purple highlighted trendline extension, currently at 322.90, from being a decent support, as we saw back in February this year, into more or less just a nuisance and now possibly overhead resistance. And finally, the small, bright green, late August to late September based ascending triangle, the apex at the end of last week. I suspect this last one was the key from the recent drive higher. So, last week prices peaked at the bright red upper bull channel line, near the congestion at 349.20, and have headed down since, this week breaking below the bright red lower bull channel line, back below the dark blue upper time, and back below the purple trendline extension. I will for now concentrate on the break below the bright red bull channel line. The move lower is close to moving from a breach lower to a full break lower, and I suspect I may soon have to set some targets below, but for now I'll only rate them as potentials. Thus, a primary potential will be down in the 313.60 zone, which is not very far, with a secondary, harder to reach potential down in the 298.10 zone. If this should come about, then it raises the point that the dark blue bearish shift picture could have repaired the break higher seen these past 2 weeks. I now only need to remind you once again of my words of 67 weeks ago and ever since, so well over a year and a quarter ago, when I pointed out that Chicago soybean meal was about to have that rarest of patterns, an annual key reversal down. This duly came about at the end of 2023, and we've been living in the shadow of this pattern ever since. Chicago soybean oil. The main recent actions over the summer here had been the construction of an early July to late August bear channel that almost from the start broke down through a key support that is still now acting today as a resistance, and that is the bright red highlighted neckline extension, currently at 45.12, of the October 2019 to February 2020 head and shoulders top. The start of this bear channel began with the market rejecting the overhead gold highlighted long moving average, currently 44.99. And I hope you can see the symmetry between back then in July and what we have seen last week and this, and the end of the move down of the bear channel. Finished in mid-August, really in the middle of nowhere, between the then overhead November 2020 high at 39.04 and the December 2020 low below at 36.56. However, it was not a simple end, as the price over August to September took a second crack at the heading lower, which failed. And we ended up with not only a dark blue mid-August to mid-September bullish Andrews picture, with the market at this time in between the overhead dark blue middle time, currently at 45.23, and a dark blue lower time below, currently at 42.06, but we also ended up with an August to September double bottom, with a primary target X in the 46.36 area, and a secondary, harder to reach target X1 up in the 47.56 area. Not only that, but going back to the old bear channel pattern, we still have outstanding the potentials for a break up and out of this pattern. Thus, as I said 7 weeks ago, we have a primary target X2 up in the 48.23 area, and a secondary, harder to reach target X3 up in the 49.50 to 60 area. However, as I said 7 weeks ago, and I quote, these two targets topside, I also said that 7 weeks ago, these two targets topside are not too far away from each other, and the move up would have to be quite dramatic to even have a look at them. So I'm cautious about them right now. However, it may not be too much to ask for a move up in between the green short medium moving average and the mauve medium moving average, relieving some bullish pressures built up from the bear channel. End of quote. And as I said now 5 weeks ago, and I quote, you can see from that I'd have been happy for a move up to the green and mauve moving averages to relieve the bullish pressure, and that is what we have seen since. We now have overhead beyond the dark blue middle time at the bright red neckline extension as resistance, along with the gold long moving average. It seems the more the market tries to move away from this bright red neckline, the closer it gets to it. End of quote. Late last week, we saw prices try up to that bright red neckline and the long moving average combination and get immediately rejected back down to what is a good journeyman support at the 42.67 level. The question of what is next is now becoming quite interesting as the dark blue lower time, currently at 42.06, crosses over the 42.67 congestion in the middle of next week. And that means that something, possibly even everything, has got to give. One definitely worth watching closely, this one, as the usual operation of finessing the bullish Andrews pitchfork into a shallower bullish shift pitchfork does not work here.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Service International Limited. And here comes the final important bit.